Good day, everyone, and welcome to FXDD Basic Chart Patterns webinar. My name is Nenad, and I'm with you, educating you and live trading with you. We had an earlier start of this webinar, but this webinar is being recorded and it will be uploaded to a YouTube channel, FXDD channel, so you will be able, of course, to watch it later. Before I start, have in mind that Forex trading carries a high level of risk that is not suitable for all investors. Please educate yourselves on the risk associated with Forex market before you start trading live. Everything you see and hear from me is my personal opinion only. Also, guys, before I start with live trading and on FXDD live account, you can see my performance, 341.57% gain. The account now is even higher. Now we have a trade that is currently running. And well, I'm very happy to announce that you see we are again in profits. I hope that profitable trades will continue. Okay, so this is what we currently have, and this is how we are actively trading the price. Okay, so before I start with the education, I want to tell you that you can sign up for more live education and trading videos on these web addresses, guys. So don't forget to do it. And effectively, you will be able then to enjoy fully our trading ECS and FXDD combined, guys. Okay. So now let's start with the webinar. So we will talk about chart patterns and different types of chart patterns. So what are chart patterns? What do they represent? Basically, chart patterns are reflections of price action in a given time. A chart pattern represents a pattern which is formed within a chart when prices are graphed. So when price moves, usually it forms some formations. Those formations we call chart patterns. It's a very commonly used in technical analysis, and they can be either a reversal or continuation signals. They can also be used to project price action and to react subsequently. So by doing that, by actually projecting the price action, you might analyze the price. By reaction, you effectively are entering the market, the trade. So chart patterns are something that many traders use, and that is very, very common, of course, with between Forex traders. Also, guys, what is important is to say that they appear naturally on the chart. So they're not like artificially made, and you see that something is going on, and some, I don't know, traders can make it themselves. No, when majority of traders move the price, when price moves, okay, followed by smart money, okay, then the price chart patterns appear, and many traders use them to assess the overall analysis, sentiment, and potential entries in the market. Have in mind that triangles and flags appear during the indecision, accumulation, or distribution, excluding flat top and bottom ascending and descending triangles. There are four main market phases. Those are accumulation, distribution, mark up, and mark down. Everything that appears in those market patterns also appear on charts. So market actively chart the patterns, and new traders join these activities, especially on a breakout, because chart patterns are mostly traded as breakout trades. There are standard and non-standard chart patterns, but today we are dealing only with basic patterns, and some special patterns I will, of course, show you in one of my next webinars and presentations. So let's cut it to the chase, guys. In these red rectangles, we see bearish chart patterns. In these green rectangles, we can see usually, well, neutral or two-way patterns. In blue rectangles, we see bullish patterns. So head and shoulders is the one of the first patterns that we usually learn. It's a bearish pattern. It's called shoulder, head, shoulder. And usually when the head and shoulders appear, you know that the price is probably going to drop. Then we have descending triangles. Okay, I will start first with bearish. Then we have descending triangles. When a trend line at the top is descending, and when we see that the bottom is flat, we call that a descending triangle. Usually it's traded when the price breaks a lower bottom. We already had a webinar that dealt with breakout trades, but it's okay to mention that breakout trades are done in 3 separate ways: trigger happy trades, breakout retest, and breakout pullback continuation. We will mention them, of course, again and again during the course of our educational sessions. Then next bearish pattern is also it's called M, and it's actually a double top. You see there is a double top, and it represents the M letter. This is the point 1, this is the point 2, this is the point 3. When point 2 is broken, then we take a trigger happy trade usually. So we immediately enter the market. Next one is bullish wedge or continuation wedge. You see that the prices are moving up. Okay, I call this pattern actually bearish wedge because it looks like some sort of a triangle, but it's actually a wedge that has an angle to the upside. And when the price breaks the lower part, that is a continuation. Usually we have a continuation trade. It's important, especially for traders who like to trade with chart patterns, and it's important for traders who are actively trying to trade counter trend, because usually when prices are going up and bearish wedge happens, it is close to some important level of resistance. Then we have another bearish chart pattern. It's called triple top. It's very similar to double top, but instead of double 1, 2, and 3, we have actually 1, 2, 3, 4. And again, point 1, okay, and point 3 here. When this actually support is broken, we enter a trade. Neutral patterns that can go both ways are rectangles. Usually rectangle appears when price is in accumulation phase and the price is ranging. That is the time when we usually see that there is no much movement in the market and prices are just going up and down. Then we have a descending channel. Usually descending channel marks a price that moves down, but very occasionally this channel can break to the upside and make a counter trend move. Then there is a flag. This here example is bullish flag. You see, this is the pole, this is the flag. But what can happen is not just the bullish move, but very occasionally the price can also go down. So I say this is, well, two-way pattern. In its core, this is bullish, but it can also drop if there is no bullish momentum. Pennants are very similar to flags. You see, this is a pennant. It looks like a pole attached to a triangle. Pennant can also, this is the form of a bullish pennant, but have in mind that this can also break to the downside, making a potential breakout trade to the downside, giving you actually pips that you probably didn't watch for, because fake outs on pennants are also very common. Symmetrical triangles, similar to all these patterns that can move both ways. On symmetrical triangle, you can trade up and down. When it breaks, usually it marks a form of a breakout trade. It can go anywhere, both ways. Then we have also, we need to mention descending bullish patterns, common chart patterns, basic ones such as ascending triangle. Ascending triangle always has a flat top here, trend line, and ascending bottom trend line. So this triangle is also called flat top ascending triangle. And when flat top breaks, this is the time that you go for a breakout trade. a double bottom 1 2 3, similar to double top. When point 2 breaks, we go up. It's called double U. Wedge reversal, the prices are different to wedge, bearish wedge. Prices are going down, and when the break of the upper trend line happens, this is the time to actively go for a long trade. Then we have a triple bottom. Price makes a triple bottom. The break of this double top is actually an invitation for a potential long entry. Now, guys, head and shoulders are also have its counterpart. It's called inverted head and shoulders, or bullish, SHS. This is the example of head and shoulders here. You see, this is the left shoulder, this is the head, and this is the right shoulder. When the right shoulder breaks to the upside, okay, then we have a potential long trade. And it happens very often when prices are bullish. Broadening wedge is the pattern that I never trade, simply because it's very, very dangerous to trade. And also, guys, it's a no-no for any serious trader. Guys, this is what you need to stay away from. I intentionally put broadening wedge here because it looks like a megaphone. So it looks like, you know, it's broadening. And price is always making some sort of new tops and new bottoms without any zigzag clear trend. I never trade this. Rectangle tops is, as I mentioned, bullish consolidation pattern. When you see the move is going up and then the consolidation, usually we might expect a continuation to the upside. Scallop is J-shaped letter pattern, and usually when you see the scallop, you might assume that the uptrend is going to continue. So I really like to see scallops because they usually mark a new move in the market. As I already explained, for you, if you're a novice trader, it's very important to focus on M and W because those are very, very basic chart pattern formations. So I'm going to show you how to actively trade these formations if you're a novice trader. Now, of course, if you're an experienced trader, this might not be interesting for you, but if you're a novice trader, this is how you trade it, guys, with those 4 very basic and simple patterns. When you see the M formation, you wait for the breakout of point 2. You always add 2 pips plus the spread to the breakout point. Okay, 1, 2, 3. They're always the best on higher time frames. When I say higher, I refer to at least 1 hour or 4-hour time frame. On lower time frames, they're not that certain. They have more success ratio on lower time frames. So 1, 2, 3. You mark the point 2 and you go with 2 pips below the price plus the spread. W is 1, 2, 3, but the point 2 is to the upside. When price breaks point 2 by 2 pips plus the spread, you open a trade. Alternatively, you might wait for a retest and then entry. Or here also a retest. When price goes up, then it goes down. It's called a retest. Then it starts to move up. You go then long. As I explained, it's called breakout retest trading, but most of the time, because this is like a form of scalping, I personally like to if I see M, I trade it. I just move my stop loss to break even +1, and if I'm in profit, I'm securing so-called free ride. So that is how I do. I usually go with trigger happy trades. Bullish and bearish, SHS, also known head and shoulders and inverted head and shoulders. This is shoulder, this is head, this is the right shoulder. Classic technical analysis tells you that you go short when trend line is broken. I go short at the top of the right shoulder when I notice candlestick reversal pattern. So what I want to see is shoulder, head, shoulder formation. And then at the top of the right shoulder, I want to see bearish candlestick reversal pattern. If I see a reversal, bearish reversal candlestick pattern, then guys, I enter the market right at the top of the right shoulder. This is my personal advice to you. I mean, this is how I trade. And if you do this, then you might secure more pips than just by trading a neckline that usually the price moves a lot before the neckline is broken. And if you trade neckline, then you need to wait for a retest, not trigger happy, but retest and then enter the market. Because by the time a neckline is broken, the price has already moved down. So you need to be careful. Short from the right shoulder on a bearish reversal candlestick pattern or on a retest of a neckline. Then there is inverted head and shoulders, so-called bullish SHS. When a neckline is broken, you wait again for a retest of a trend line and then you go long. Or you can go long at the bottom of the right shoulder, waiting for some bullish reversal candlestick formation. Bullish reversal candlestick formations are usually pin bars, inverted hammers, nice, for example, piercing line. I like the pattern a lot. The bullish Marubozu candles, or let's say doji, long leg doji. Those are all patterns that you might use at the bottom of the right shoulder to effectively join the smart money and make an earlier trade. And guys, this is basically how you trade this. So focus on M, W, okay, these are important. M, W, shoulder, head, shoulder, bullish, bearish and bullish, and try to trade it the way I do, because believe me, you will be happy. And the last thing, guys, don't forget to join live trading sessions, guys. This is our live account. Here we are trading actively, and the deposit was 10,000. Now it's 44,000. Join our live sessions and follow our My FX book, okay, with FXDD live account. I wish you a great trading day. Enjoy this, guys. Use it, and see you soon. Cheers. Trade safe.